Hi, I'm Doc Severson. In this short video, I'm going to show you a new way of analyzing and forecasting financial markets that works with any instrument and with any time frame. It's especially useful for today's stretched financial markets. Let's take a look.
Now, why am I suggesting that we need something new? Well, I think we can all agree that this isn't your father's stock market anymore. Markets move very differently than they did just a few years ago, and a lot of this is due to quantitative easing. What used to be a rumor about unreported money supply back in 2005, or the mythical plunge protection team, turned out to be true. We're currently buying $75 billion a month in bonds to create the wealth effect. And it's no surprise that this money has found its way to the stock market, since there's no point in putting it into money markets or passbook savings. So what consequence has this had on the financial markets that we trade? It's fundamentally changed how markets move. If we bring up a chart of quieter times, such as the S&P 500 from the 2005 to 2006 timeframe, we can see how the market was very choppy and slow moving. Standard technical analysis tools like oscillators worked great to be able to identify turning points in the market with great accuracy. But in today's market, which we've seen since they really turned on the jets back in 2010, we get trends that go forever without meaningful pullbacks. We're also seeing price rise faster than it corrects, which is very unusual. So what happens when we try to use yesterday's tools in today's markets? First off, oscillator tools like stochastics get swamped, as you can see in the bottom graph. This tool stays in the overbought zone for a long period of time, and the crossover signals don't mean much of anything. So then there are momentum tools like the venerable MACD, which show cross after cross to the downside, and the signals fade into noise. So more experienced traders use divergences to identify when the trend is tiring, and we might close down longs or take the opposite side of the trade. When we see prices making higher highs, and the MACD is making lower highs, as well as stochastics making lower highs, we have Class A negative divergence, which was one of the strongest technical signals in previous years. But this technique is not giving us any edge either, as the trends are overpowering the divergences. Normally, when we can't get in tune with what's happening on the chart, the usual solution is to add more indicators. So if 2 indicators is good, then 3 must be better. So most of us just continue to pile on the technical indicators until your chart becomes a pile of spaghetti and obscures the one thing that's really important, which is price. Folks, adding more indicators to a chart does not provide more clarity. So what do? These standard tools that worked so well in the previous choppy years don't work so well in today's environment. The usual response to this is to find a different holy grail indicator and see which one curve fits the best. Or we can rethink the problem and come up with a better approach, which is what we're going to focus on for the rest of this video. Now, the root problem is that we don't really know what's happening to the markets themselves. And we're trying to compensate for that by slapping on these random trailing indicators and hoping that they'll provide an answer. Why don't we try finding the root of the answer instead? Because wouldn't it be great to learn one system that worked year after year, regardless of the type of market that we were seeing or what external forces were doing to the market, and work for just about any trading strategy that you wanted to implement? It would let you understand what was happening to the underlying market that you were trading to give you a consistent performance edge. And isn't that what we're all after? Stick with me for the next few minutes and I'll show you exactly how to obtain that edge. There are 2 main concepts that we use to define the nature of fractal energy trading. The first is that markets are fractal in their nature and how they move. We'll define this term in just a minute. Secondly, markets move in a never-ending cycle between range expansion and range contraction. They're either trending or consolidating. Once you see these in action, they'll make more sense and you'll realize how much you already know. Okay, so what does this fractal term mean? Fractal means that larger things are made up from identical smaller things. And these smaller things are really miniature versions of the larger things. You've already seen this concept everywhere. One example would be a tree. When we look at a tree, we see the entire tree. However, if you study it, the entire tree is built from a collection of increasingly smaller tree patterns. A branch is really just a miniature tree by itself. So what is the connection to markets? They do the same thing, creating smaller time frame patterns within larger time frame charts. We use a factor of 5 to break up the chart time frames. For this chart of the S&P 500, we break this factor of 5 up, starting with the monthly chart on the left, and the next time frame is the weekly chart, approximately 5 times faster than the monthly chart, to the daily chart, which is 5 times faster than the weekly chart, and eventually to the intraday chart, which is 5 times faster than the daily chart. Think of the relationship amongst these time frames in terms of parent-child. We have 2 major parent time frames at the monthly or weekly level, and 2 child time frames at the daily and intraday level. When the parents want to go somewhere, the child time frames are going for the ride. But disturbances from the child time frames, whether they are just pulling back or consolidating, will slow down the progress of the parent time frames. For those of us that are parents ourselves, can't we just see this happening in our own lives every day? So we can define this behavior with a couple of rules as it relates to fractal price action. The larger or parent time frames establish and dominate the trend. There's no surprise there. We can see this in action with the monthly chart on the left establishing the main trend and the weekly chart working inside of it. And here's the second rule, which is less well understood. Reversals in the trend start from the inside out and propagate upwards. You can see in this example how the intraday chart on the right-hand side changes polarity first back up to an uptrend and stops the pullback of the daily chart on the left-hand side. The trend reversal propagates upward. By understanding the trend condition of each of the parent-child timeframes on a chart, whether it's uptrend, sideways, or downtrend, I get a great sense of where the chart has been and where it's likely to go from here at each time frame. If I had to, I could trade with this fractal chart series with no indicators on the chart at all. Okay, now earlier I said that fractal energy trading had 2 main concepts. We just covered the fractal part. How does the energy part come into play? I think this is the really cool part because the energy concept is related to how far markets are likely to trend. And isn't that the biggest issue that we have with today's market? Not knowing how far markets will trend or when they will slow down and reverse. So now let's discuss market energy for a minute before we put it all together with fractal energy trading. If we know how much energy each time frame has, then we know the overall potential of the chart to either keep trending or start to consolidate. Let's go back to our family of time frames again. And let's say that they're just starting out on a family vacation trip. How easy is it for them to make progress when everyone's excited and looking forward to arriving at their destination? But how easy is it for them to make progress when one of the children is exhausted later in the day? Tough to just keep going when little Johnny has had an accident. And even later in the day, how much further is anyone going to go when one of the parents is exhausted? I bet not very far. Now back to the charts. If one of the child time frames is low on energy, then we'll expect to see the major trend pause before continuing. But if we see one of the parent time frames low on energy, we'll expect to see the trend stall out there, perhaps even begin a reversal. Well, I'm sure you're curious by now how we go about measuring energy for the different time frames. Do we have a fuel gauge on the chart? Well, not quite. We measure energy expended on any particular trend based on the linearity of the current trend on each time frame. A long linear trend takes a lot of energy to keep going, while consolidation or choppy price behavior restores that energy or winds the spring back up again. To measure this on our charts, we use a little-known indicator called the Choppiness Index. When it's above 61.8, then we have a market coiled up like a spring ready to explode. If it starts on a trend and gets down to 38.2, then that trend is in danger of stalling soon. And when it gets below 25, if it ever gets that far, that trend will fail very soon. Okay, how do we apply this? How do we make money by applying fractal energy trading? Well, let's say that you're trading stocks or options directionally. By understanding the various time frames and energy levels, you can spot prime conditions that those huge trends come from. Or if you're currently in a trade, you can estimate what the potential might be of the current trend so you can maximize your returns. And lastly, you can identify conditions that chop the rest of the herd to pieces during those times where you might want to be on the sideline or using a different market. Okay, what about the option traders out there, especially those that are playing non-directional strategies where we're selling premium like iron condors, butterflies, time spreads, or any other complex strategy where we're looking to catch the market in a range. Using fractal energy trading, we're going to be able to do a better job identifying those conditions where the charts are about to start trading in a choppy range, which is when the price action is in our favor. And conversely, you can anticipate those times where charts are about to explode and you can switch to a more directional strategy. But to me, the biggest benefit of all is that it allows you to really understand what a market is doing and why it's doing it. You're no longer hostage to the whims of a system that doesn't work in these quantitative markets. Okay, let's see how we can profit from this system with different strategies. The first example here, I'll use the S&P 500, and we're looking at the monthly time frame on the left. So here's the monthly, here's the weekly, and here's the daily time frame. We'll just use these three time frames instead of the whole family of four. First of all, we'll look at the trend. Obviously, in the monthly chart, we have a strong trend here. In the weekly chart, we have a strong trend to the upside. And in the daily chart, we do have a strong trend, but we can see that that trend went from range expansion to the upside to range contraction. We can see that when we had this Choppiness Index down below 25. So it was very likely to go from that range expansion to range contraction. But guess what? After about 3 weeks of coiling sideways, that spring gets wound up tight. So I wanted to take a long in the direction of those weekly and monthly trends that are going to the upside. Remember, those parent time frame trends are pulling to the upside. Let's look for the next breakout to the upside on the daily chart. So we simply took a range breakout with a simple call option trade, and you can see that just a couple of days later we are out of that trade with a nice gain. Look at all the energy that this chart has built up at this time frame. Now you notice that we didn't try to go long when the energy was buried down here. We waited out all the chop. We waited until everybody got chopped to pieces down in this area and simply waited until we had a full tank of energy at this time frame, and the chart was showing a very high probability of breaking out to the upside. So it was just that simple. We let ourselves into the trade, and we just took a simple call option trade that returned us 23.2%. All right, the second example is also on the S&P 500, although this system works with any underlying stock. Again, we're going to look at the trend, and the trend is to the upside. Yes, to the upside on the monthly and the weekly. However, what we're also seeing is that we're starting to run out of gas on the parent time frames. So remember that family vacation where the parents are tired? We're starting to see a very high probability of consolidation at these levels. And so we had the same thing happening. This is a relatively rare signal where we had all three major time frames showing potential exhaustion. And that was into the very last day of the year on December 31st. And so what I did on that day was sold what's called a bear call spread, which is a bearish trade. We sold it for the February cycle, way up here, way beyond this level actually, at the equivalent 1930 level. So 1930 was the short strike on that bear call spread for the February 2014 cycle. Now this is a contrarian setup where we're going against the trend, but in this case we can see that we have three time frames that are all crying out for a rest. According to our system, there is a very high probability that we're going to see some type of sideways price action at this point for an extended period of time, or at the very least a pullback. So here's our entry on the position with the S&P 500 ETF, the spiders, where we sold the February 193 call option for 37 cents. and simultaneously bought the February 195 call option for 21 cents. The difference is a 16-cent credit, meaning that I'm looking to earn a potential $160 on this trade if the price stays below the SPY 193 level by February expiration. This is a bear call spread, and it's a bearish to neutral position that depends on the price not continuing to rocket higher. Here's the chart just a couple of days later. You can see that I entered this bearish position right into the teeth of a strong uptrend, when every pundit out there was pounding on the table to buy stocks, because my system showed that the chart had an extremely high probability of taking a rest at this level. And that's exactly what it's done over the last few days. In fact, I could close this position right now and earn a third of the potential gains. We're just looking to understand what's going on in the chart and putting probabilities on our side. It's very simple. Okay, I've thrown a lot of information at you in a short period of time. If you want to know more, I'm going to be giving a live 3-hour workshop on Saturday, January 11th. We're going to be going over how to read and interpret fractal price action, how to interpret market energies on multiple time frames, and how to combine both of those together to form fractal energy trading. We're going to be applying this to different directional and non-directional strategies. We'll show you how to put it into play. And we're going to be answering your questions live. You will receive a recording of the session, plus all the written materials that we use. So here's what this program will do for you. First of all, improve your ability to analyze and forecast charts. It's going to declutter your charts with simple reads. You're going to be able to spot the potential big movers before they take off and leave them before they chop around. It's going to give you one basic system that you can use regardless of your trading style. Now, who is this for? Well, really anyone that wants to learn how to improve their price action analysis. It works for any type of trader, regardless of what you trade, stocks, options, futures, or Forex. And it works in any time frame, whether you're a position trader, a swing trader, or even a day trader. Anyone that wants a better technical analysis foundation and a proven lifetime system that's going to work year in and year out.
So, what do you need to do from here? Underneath this video, you'll see a button that says Sign Up Now. Click on this button and it'll take you to a secure order form. Fill out the form and you'll receive an email with the details of the online workshop that's being held on Saturday, January 11th. The workshop will be recorded, and you'll receive access to the recording shortly after the class wraps up. So even if you can't attend, you should sign up now. Thanks, and I'll see you there.